Welcome to the July 2025 Evergreen Asset Allocation Committee meeting. Without further ado, let's start the meeting with an economic update by Mav. Federal Reserve Leadership and Policy Implications. MAV highlighted significant concerns regarding speculation about Federal Reserve Chair Jerome Powell's potential dismissal by President Trump, despite Trump's subsequent attempts to downplay such threats overnight. MAV noted Trump's extraordinary public criticism of Powell, referring to him as a knucklehead and stupid guy, which represents unprecedented presidential commentary about a Federal Reserve chairman. The administration is reportedly considering using a $700 million cost overrun on Federal Reserve building renovations as justification for removal, stemming from asbestos and lead contamination issues that arose during a modernization project initiated in 2017. MAV expressed concern that Powell's replacement would likely try to implement rate cuts in an environment where inflation conditions may not justify such action, potentially creating a steeper yield curve. Kingsley Jones characterized this as the first instance of a president explicitly threatening to dismiss a central bank chair for not complying with political will, describing it as eliminating any semblance of central bank independence. Both MAV and Jones agreed this represents a negative development that could lead to inappropriate monetary policy decisions, with potential successors including Kevin Hassett and Scott Bessent, though Bessent has indicated satisfaction with his current Treasury Secretary role. In discussing the U.S. economy, MAV noted that it does not look like a recession is around the corner. The labor market is softer, but not collapsing, while initial claims are creeping higher. Meanwhile, real retail sales are holding up, and capacity utilization appears to be improving. Core CapEx has also remained solid. Inflation dynamics and economic indicators. The latest Consumer Price Index data showed headline inflation at 2.9% year-on-year, though MAV noted this figure benefited from favorable seasonal adjustments that would have resulted in a 3% reading under previous methodology. Core goods inflation, whilst modest at 0.7% annually, is showing concerning momentum, with household furnishings experiencing their fastest growth rate in considerable time, suggesting early tariff pass-through effects. MAV indicated this tariff impact is occurring earlier than anticipated, though he expects the primary effects to materialize later in 2025 and early 2026, as current subdued inflation reflects inventory built up at more favorable pre-tariff prices. Trimmed mean and median inflation measures are running comfortably above 3% and rising, indicating underlying inflationary momentum. Producer Price Index figures released overnight showed approximately zero growth, potentially providing temporary relief before tariff effects intensify. The quarterly annualized inflation data over the last 3 months is running in the mid-2% range, which MAV considers manageable. However, he emphasized that the critical inflection point for determining inflation trajectory will occur around year-end, when either inflation accelerates or proves manageable, enabling potential rate cuts and market acceleration. Global yield curve dynamics and market positioning. Market positioning for Federal Reserve rate cuts has shifted dramatically, with no expectations for cuts at the upcoming meeting and only 15 basis points priced for the September meeting, compared to previous positioning of 25 basis points or more. MAV presented data showing break-even inflation expectations have risen from 2.29% to 2.41% since early July, whilst real yields have moved above 2% from below 2%. The term premium has increased, partly attributable to the One Big Beautiful Bill Act signed on the 4th of July, which the Congressional Budget Office estimates will add $3.3 trillion to the deficit. MAV anticipates the term premium could reach 1% over coming quarters, representing a material shift in bond market dynamics. Australian real interest rates are approaching 2% and have likely exceeded 2.2% since the data collection on the 9th of July, creating concern about the economy's capacity to handle such elevated real rates, given productivity challenges and reliance on population growth. The Australian market has priced an approximately 80% probability of a rate cut at the 12th of August Reserve Bank meeting, with expectations of 2.2 cuts by Christmas, reduced from previous expectations of 3 to 4 cuts. Mavi suggested the July pause decision likely reflected a 6-3 board vote, with the majority led by Governor Bullock and 3 dissenting votes probably from newer Labor appointees. Governor Bullock prefers to wait for the June quarter CPI print, and that the RBA wants to avoid having to fight inflation again. MAV thinks rising uncertainty around global inflation and geopolitical risks also played a role in reaching a decision to keep rates steady. Traders remain comfortable with price trajectories, and long-term break-even inflation rates are hovering around 2.6%. MAV noted that estimates for the nominal neutral cash rate are thought to be around 3%. Given Australian households tend to deploy excess savings more readily at lower interest rates, MAV thinks the neutral rate could be a little higher. This would pave the way for 2 rate cuts in 2025, being August and November. A third cut might be one too many, given productivity concerns, and potentially set fire to the housing market. Equity market valuations and sector performance. Australian equity markets are trading at extreme valuations, with the All Ordinaries at 19.6 times historical earnings as of 30 June, which MAV described as insanity relative to history, given the absence of supporting growth prospects. Morgan Stanley data revealed several sectors trading at 10-year highs, with financials at 20 times earnings and consumer staples at 25 times earnings, both representing historically elevated multiples. The real estate sector's apparent 19.1 times multiple is distorted by Goodman Group's influence, with the sector representing better value when this outlier is excluded. The recent 4-week sector performance showed consumer staples declining nearly 4 to 5%, whilst healthcare has rebounded after struggling throughout the year, and energy has benefited from international events and Santos's takeover bid. Gold miners have declined 16% over the past month, despite maintaining approximately 33% year-to-date gains, reflecting momentum loss in underlying bullion prices and company-specific issues such as Northern Star's cost challenges. The banking sector, up nearly 10% year-to-date despite no growth, has benefited from net interest margin expansion as institutions reduced deposit rates in anticipation of Reserve Bank cuts. Stephen Duchesne noted extremely low pairwise correlations between stocks at approximately 7%, indicating a highly stock-specific investment environment requiring individual security selection rather than broad market exposure. We note that this was an abbreviated market and macro discussion on this occasion, and that further updated are available in the slides, particularly relating to the UK, Europe, India, and China. Monroe Partners Global Growth Mid and Small Caps Asset Allocation Meeting. Market Valuation Gap and Investment Thesis. Chiao Ma presented Monroe Partners' investment thesis for global small and mid-cap growth stocks, which originated from observing the significant valuation gap between small mid-cap and large-cap equities. The valuation differential, measured by price-to-earnings ratios using straight average calculations, reached its widest point in 20 years when the strategy was initially conceived, expanding further to a 20-year high by the fund's launch. Ma noted that despite the fund's strong performance, nearly doubling investor capital over 2 years, this valuation gap has continued to widen, particularly due to the recent performance of companies like Nvidia and Microsoft. Stephen Duchesne raised concerns about the calculation methodology, questioning whether simple averages versus market cap weighted or median calculations might yield different results. Ma acknowledged this limitation, but emphasized that the gap's magnitude rendered precise measurement less critical than the directional opportunity it represented. Historical analysis suggests such gaps typically close when interest rates begin falling, with small and mid-caps potentially trading at premiums to large caps for extended periods during subsequent cycles. market attention disparity, and information inefficiency. Ma illustrated the fundamental information asymmetry between large and small capitalization companies using analyst coverage as a proxy for market attention. Large cap growth leaders such as Nvidia and Meta receive coverage from approximately 40 to 45 analysts, ensuring rapid information dissemination and price discovery following earnings releases. In contrast, comparable small cap companies in identical sectors receive coverage from an average of 5 analysts, with Ma noting that only 2 typically conduct substantive research while others produce peripheral commentary. This disparity creates significant delays in market reaction to earnings results, with large cap analysis completed within 2 hours of earnings calls compared to days for small cap equivalents. The quality differential extends beyond timing, with small cap research typically shorter and less insightful. Kingsley Jones acknowledged this as demonstrating the value proposition for active management in uncovering informational opportunities, citing Curtiss Wright as an example of a company central to nuclear infrastructure, yet overlooked by investors focused on more obvious uranium plays like Cameco. Portfolio diversification strategy and risk management. The investment approach centers on 8 uncorrelated growth tailwinds: security, big data, infrastructure, high-performance computing, digital media, healthcare software, and travel. Ma emphasized these sectors' individual drivers and low correlation, enabling portfolio construction that avoids concentration risk while maintaining growth exposure. She highlighted that strict quality standards or equivalent should be applied to large cap investments, with all holdings being profitable. Cash-generative companies with low leverage, predominantly founder-led. Mavi questioned corporate governance standards given reduced analyst scrutiny, with May stating that no compromises should be made, with the same governance standards applied across all holdings regardless of size. Ma stated that typical small cap volatility of small caps can be mitigated with diversification. When asked about activism, Ma confirmed a purely passive approach, engaging in discussions and suggestions, but avoiding activist positions. Earnings growth acceleration and regional allocation. The presentation highlighted accelerating earnings growth across multiple portfolio companies, with MR providing specific examples including Canova in semiconductor inspection software, Axon in law enforcement technology, and Interactive Brokers in trading platforms. These companies demonstrate earnings acceleration driven by structural tailwinds rather than cyclical factors, occurring before anticipated interest rate cuts. The fund targets companies capable of doubling earnings over 5 years, requiring consistent 14 to 15% annual growth rates. Regional allocation results from stock selection rather than geographical mandates, with 75 to 80% of holdings in US companies due to their superior ability to meet growth criteria. MAV inquired about regional opportunities, with May noting that while some emerging market companies like Tencent Music offer better valuations than developed market equivalents like Spotify, most companies meeting the fund's growth standards remain US-based. The security sector allocation includes US companies Curtiss Wright and Leonardo DRS, with Ma explaining the preference for Leonardo DRS over its Italian parent company Leonardo due to superior earnings growth, cleaner financial metrics, and specific exposure to US Navy submarine programs, particularly the Columbia-class submarine initiative. Bell Asset Management, Global Quality Mid and Small Caps Asset Allocation Meeting. Market Structure and Composition Analysis. Joel Connell provided comprehensive data on the global small and mid-cap universe, clarifying common misconceptions about this market segment. The MSCI World Small Cap Index encompasses the bottom 28% of market capitalization across 23 developed global markets, containing approximately 4,600 individual companies. Connell emphasized that the vast majority of constituents sit between $1 billion and $50 billion in market capitalization, with the top 10 holdings averaging $59 billion and the weighted average across the entire index at approximately $16 billion. This contrasts significantly with the MSCI World Large Cap Index, where the top 10 holdings approach $2 trillion on average, and the weighted average reaches $980 billion. The geographic composition shows the US representing 60% of the index, demonstrating less concentration than broader large cap benchmarks, which exceed 70% US weighting. Connell noted that sector diversification is notably superior to other indices. The evolution of the mid-cap segment reflects dynamic thresholds that have shifted higher over time due to global economic growth, inflationary pressures, and general equity market appreciation. The upper cutoff for global small or mid-cap companies was significantly lower 15 to 20 years ago, at perhaps 10 to 15 billion, but has necessarily adjusted upward as the world economy has expanded. Performance characteristics and risk profile. Historical performance data revealed that global small caps have outperformed large caps by 1.2% per annum over a 25-year period, though this outperformance has not been linear. Connell acknowledged that small caps have lagged their large cap counterparts in recent years, but maintained that the long-term superior returns are attributable to consistently faster revenue and earnings growth. When questioned by Stephen Duchesne regarding Sharpe ratios, Connell acknowledged higher volatility in small caps, but indicated that risk-adjusted returns may be similar, though he lacked specific figures at the time. The presentation highlighted concerning concentration risks in both Australian and global large cap markets. The ASX 300's top 10 stocks comprise nearly half the index, with financials and materials representing over 50% of sector allocation. CBA alone constituted over 10% of the index and approximately one-third of total returns in the fiscal year ended. Similarly, the top 10 names in the Global Large Cap Index represent 30% of the index but contributed almost 60% of total returns in calendar year 2024. By contrast, the top 10 stocks in the Small Cap Index represent under 3% of the total, providing significantly better diversification. Market inefficiencies and investment opportunities. Connell presented compelling data on market inefficiencies within the small cap universe, describing these companies as hidden gems that are significantly under-researched. Companies within the MSCI World Small Cap Index are covered by only 9 sell-side analysts on average, compared to over 70 analysts for the MAG 7 and approximately 40 analysts for the top 50 global stocks. One-third of the small cap universe has 5 or fewer analysts covering it, whilst nearly 2/3 have fewer than 10 analysts. This lower coverage translates to reduced informational density and greater potential for mispricing. The fundamental growth characteristics support the investment case, with small caps consistently delivering faster revenue and earnings growth than large cap peers. Connell attributed this to structural advantages including earlier life cycle positioning, longer expansion runways, greater agility, and reduced bureaucratic constraints. These companies can pivot more quickly to capitalize on emerging trends, respond to competitive threats, and bring innovations to market with greater speed. The portfolio approach focuses on quality companies that are already profitable rather than speculative investments, with Connell citing Cencora, a US pharmaceutical distributor purchased in 2011 at approximately $10 billion market cap, which has compounded at close to 15% per annum and now approaches $50 to $60 billion. Current market positioning and future outlook. The valuation analysis reveals a significant dislocation between small caps and large caps, with the small cap index trading at a 15% discount to large caps despite faster growth rates. Compared to the large cap growth index, the discount extends to approximately 40%. This represents a notable shift from historical norms where small caps typically traded at a premium to large caps. Over the past 7 years, the contribution from earnings growth has been similar between small caps and large caps, but large caps benefited from major valuation expansion with PE ratios increasing from 15 times to 20 times, whilst small cap valuations remained sideways or declined slightly. Connell presented a hypothetical scenario based on earnings growth aligning with 10-year averages and valuation reversion to historical norms, suggesting global small caps could deliver returns approaching double digits per annum over the next 5 years, compared to less than 5% per annum for large caps under similar assumptions. Sell-side consensus forecasts support this outlook with earnings growth projections of 14% per annum for small caps versus 10% per annum for large caps. Potential catalysts include macro uncertainty, resolution, interest rate clarity, M&A activity revival, and rotation from crowded mega-cap growth stocks. The balance sheet health of the small cap index has improved significantly, with average leverage declining from 3 times pre-COVID to 1.7 times currently. Moving on to the panel's opinions on the economics and the portfolio implications. The committee conducted a comprehensive review of current market conditions, with particular emphasis on the small and mid-cap opportunity following presentations from 2 specialist managers. Members noted the structural advantages emerging for smaller companies, particularly the asymmetric benefits that AI technologies provide in leveling the competitive playing field against larger corporations. The committee observed that smaller companies now have access to sophisticated tools and capabilities that were previously exclusive to large cap entities, fundamentally altering the competitive landscape. Discussions centered on the concerning dichotomy between large cap overvaluation and small cap relative value, with the committee concluding that the valuation gap primarily reflects large cap excess rather than small cap undervaluation. This observation was supported by earnings growth differentials, where smaller companies demonstrated superior fundamentals despite trading at more reasonable multiples. The committee acknowledged the liquidity risks inherent in small cap exposure during market dislocations, while recognizing the long-term total return premium historically available to investors willing to accept this volatility. Significant attention was devoted to the evolving U.S. political and monetary policy landscape, with members expressing concerns about potential Federal Reserve leadership changes and their market implications. The committee noted that a more dovish Fed appointment could trigger a market melt-up reminiscent of the 1987 environment, potentially benefiting risk assets in the near term while raising longer-term inflationary concerns. Credit market conditions were highlighted as increasingly precarious, with corporate spreads approaching pre-GFC levels despite elevated geopolitical and economic uncertainties. Portfolio construction. The committee slightly altered its allocation to 61/39th growth defensive allocation through implementing targeted tactical adjustments across 2 asset classes. Members expressed satisfaction with the current small cap overweight position of 1%, agreeing that this provided appropriate exposure to the identified opportunity while maintaining prudent risk management given current market conditions. The most significant portfolio discussion focused on a potential reallocation toward domestic real estate investment trusts, REITs, with the committee identifying compelling structural fundamentals, including limited supply pipelines, lengthy development approval processes, and the benefits of falling interest rates. This represented a notable shift from the committee's previously bearish stance on the sector, reflecting changed market dynamics and improved relative value propositions. To fund the proposed REIT allocation, the committee agreed to further reduce global duration exposure by 1%, moving from current underweight positioning to a more pronounced negative stance. This decision reflected concerns about the uncertain interest rate environment, potential inflationary pressures from U.S. fiscal policy, and the committee's view that longer duration bonds offer more limited defensive characteristics in the current environment. The committee viewed this as a strategic barbell approach, reducing exposure to the least defensive component of the defensive allocation while increasing exposure to inflation-protected duration assets within the growth spectrum. The committee scheduled a comprehensive review of strategic asset allocation SAA targets and agreed to monitor credit market conditions closely, given observations about compressed spreads across corporate credit markets approaching levels not seen since before the global financial crisis. Thank you for listening, and we will see you next month.